Hey everyone, Bill Constain, CEO of Freedom Wealth Services, and welcome back for our five-part series of the top 5 secrets to building wealth. And this is the fourth of 5 secrets. So just in review, let's just go through the book a little bit. If you haven't read it already, you can pick up your own copy, a free copy from our website, freedomwealthservices.com. There's Benjamin Franklin, as told by the top 25%, the top 5 secrets to building wealth. And here's the opening statement. There's yours truly. Secret number 1, higher taxes are coming. The truth may actually shock you. Federal income tax rates were established in 1913. You'll read more about that there. Top marginal tax rates since 1913. Longevity must be considered. Number 1 fear retirees have is outliving their money. Don't become part of this statistic. Protection greater than accumulation. The wealthy understand that it's not about experiencing the highest gains, but rather receiving a portion of those gains while protecting the amount of wealth they already have. That's in part 3. And there you can see using an index strategy with a zero floor. This is the strategy we use at Freedom Wealth, and this is the S&P. And by the way, over 90% of fund managers can't even do the S&P, and here we are. So you can find out more about that on our website in the description. But let's move forward to the topic of the day. Secret number 4, prepare for the unexpected. The top 25% are creating what we call family banks. I love that term. I'll say it again. Family banks. They're setting aside a portion of their financial assets and putting it into a financial vehicle that has a variety of benefits, including 2 significant ones: leverage and wealth transfers. So let's first go over leverage. This is the ability to purchase items using a financial institution's money, otherwise known as OPM, other people's money, that being the bank. The wealthy do not spend their own money, but rather use their money as collateral and have the financial institution pay for their items. They take out a favorable loan. That's the key. Favorable loan. The key word there, again, is favorable, and pay back the amount of money owed. We're not talking about 30% credit cards, which is an abomination. Their money continues to grow considerably because of the incredible power of uninterrupted compound interest. By leveraging their wealth, they're able to pay for any unforeseen expenses that they might not have otherwise been prepared for. The next benefit the wealthy receive within this preferred financial vehicle is called wealth transfers. This means that money that gets passed along to children and heirs if something should happen to that person. Generally, most financial vehicles are exposed to the government when it's time to transfer wealth to the heirs or beneficiaries. When this time comes, Uncle Sam is owed his or her portion. We say Uncle Sam and Aunt Iris have to get their fair share. Most transfers include a considerable amount of taxes owed to the government and results in less money being given to their loved ones, their heirs, their beneficiaries. Think about it. If something should ever happen to you, do you want your money going to Uncle Sam and Aunt Iris, or do you want it to go to your real family? That's the big question. I'd like to see some comments. Where would you like to see your money go? Of course, you want to spend it and enjoy your life, but when all that is done, don't you want your family, maybe the institution, church, some charities? There are a lot of things out there that you probably would want to do. Okay, so again, the wealthy understand this and use a financial vehicle that protects them from the government. When they pass away, their wealth is directly given to their children. That's called a legacy. And would you prefer to have a legacy that's taxable or a legacy that's tax-free within the confines of the law? This is also called a death benefit. The acronym would be DB. Sometimes in a life insurance policy, it's called a face amount. It's getting dollars for pennies. So if you're trying to create a legacy, many of the wealthy will leverage other people's money, the banks, for pennies, and leave dollars, in many cases millions of dollars, to their family tax-free to create a multi-generational legacy. This strategy has been used for hundreds of years to safeguard their wealth and keep it within the generation to follow. Now, I'm just going to come off the ebook a little bit. 3 contingencies in life, 3 things that can happen to us while we're building our family and retirement and all that good stuff. Perfect life. 1, we die too soon. Here we are working in our 20s, 30s, 40s, 50s, making money, our family's depending on us, and we just die too soon. We just didn't expect it. So we need some income replacement for the family to stay in the lifestyle that you desire for your family. So dying too soon. Number 2, getting hurt, being disabled, right? Either physically, mentally, or both, not being able to do our job or career or run that business. That's when you need some disability, right? And retirement, that's called long-term care, right? Within a policy, you can actually have that at very little or no additional cost, that it could be self-completing if you die too soon, if you get hurt, whether in your working years or in your retirement years, so you can access the benefits. Thirdly, is living too long. I know that doesn't sound like a bad thing, but many financial planners have the accounts running to age 85, 84 for what we call mortality. Say, well, Mr. Client, let's run into mortality where you're probably going to live to about 81, 84, according to the tables. But guess what happens? People are living into their 90s and even past 100. How would you feel to be age 80 or age 85 and down to your last few dollars, right? We don't want you to have to go and get a part-time job or a full-time job at that age. It's not that easy. So we want to make sure that those assets are running for an entire lifetime, to 100, beyond 100, because we don't want you to have stress and tension. And if you were to pass away early, that's fine. You at least know that you created a legacy, you've stretched it out, and anything additional that you didn't spend in your lifetime that you would leave for your loved ones, institutions, churches, synagogues, anything that you desire. So 3 contingencies in life: dying too soon, getting hurt, and living too long. So a preview for the next one is secret number 5: seek guidance from a team of trusted advisors. Those that are successful delegate responsibly. So with that said, I want to point you to our website, and here it is, freedomwealthservices.com. And here you'll be able to see wealth strategies, video lessons, resources. You'll get a free gift here. Now, if you click the watch videos, you'll be able to see that first video. Then it'll just ask you to subscribe, free of charge. We don't ask for any credit card information. We never charge any money for the service. You can enjoy the videos at your leisure. And if at any time you have any questions or would like to set up a free consultation to see how we can apply this in your life or for a loved one, we'd be honored if you'd reach out to us either by phone or by email. And here it is. And one of our team members, or if I'm available, I'll work with you personally. Okay, so with that, it's Bill Constain, CEO of Freedom Wealth Services. If you haven't done so already, go ahead and click the thumbs up, give us a positive comment, let us know if you're interested in creating a tax-free legacy, and we'll see you in the next video, everyone. Have a great day.